As the saying goes, it's a lot easier to get $10 million in loans from a bank than a $100 loan. In recent weeks, we've covered the payday loan story, with the government determined to cap the high interest rates on short-term loans, and the biggest payday loan company threatening to take its business offshore. The stakes are high and have triggered interest from Britain, where there are no such caps. Payday loan sector chief John Lamidey is on a visit to Sydney, and I spoke with him earlier. John Lamidey, welcome to the programme.
Hello, Vicky.
We've got a very different situation as far as regulation is concerned. We've got a determined finance minister who wants to regulate payday loans and indeed cap rates. What do you think will happen here?
The research that the UK government did when it was looking at these issues actually came out and said if you cap interest rates, particularly on small sum short-term loans, you don't make them cheaper, you make them unavailable. And if you make them unavailable, that's actually quite detrimental to consumers, because what they're using these loans for is to manage their personal cash flow.
I guess the big concern is what they are using these loans for. I see on your website front page you've got just borrow what is required and pay it back quickly. I mean, that is the key thing, isn't it? To be able to pay back quickly. But if some of these people are using the loans to pay essentials, and a significant proportion of them are then rolling over those loans, doesn't this start to become a big concern?
Well, it would, wouldn't it? Yes, if that was the case. But it's not the case. And the research is quite clear that, firstly, in the UK, our customers, only just over a quarter of our customers roll over their loans at all, and those who do only roll them over twice.
You see, I find that statistic quite alarming in itself. I'm looking at, in Australia, the recent RMIT report. 78% of those surveyed were receiving Centrelink, 37% were on disability payments, 44% said they were cycling loans, and 25%, as you say, took out 2 or more parallel loans.
Yes.
Isn't this alarming?
Well, I don't think it is in the context, because, again, the UK research says that people who are using unauthorised bank overdrafts are doing that 6 times a year. People who are paying default charges on credit cards are doing that 4.3 times a year. Now, 4 million people in the UK use bank overdrafts, unauthorised bank overdrafts, and they're significantly more expensive than payday loans.
Consumer Focus, which I understand is your statutory watchdog, would that be right?
It's not a watchdog, it's a consumer organisation, but it is a statutory consumer organisation, quite right.
Now, they recommend changes to your code of practice, a number of recommendations, including limiting the number of months that a loan can be deferred for, limiting the number of repeat loans, and limiting the value of those repeat loans. Now, that hasn't been taken up in your code of practice. Why?
Well, because we set up a payday loan forum with Consumer Focus, 4 other consumer groups, 4 trade associations, 2 government departments and 2 specialist experts, and we discussed all these issues, and I have to say that those recommendations didn't get a lot of support, even from other consumer organisations. When we looked at the issues, looked at the evidence, we didn't see that they would actually benefit the consumer. The customer. So
the statutory consumer watchdog is wrong here?
They're just recommendations. They've looked at the issue. This is what their view is. Their view was thrown into the pot. We had a good discussion about it. We didn't, at the end of that discussion, having had all other views coming in as well, decide to make those changes at this point, because we didn't see that they would actually advantage anybody.
The United States has payday regulations precisely because, and I quote, 5 million people a year are in a cycle of debt dependent on repeat borrowing. Given that one would imagine that the UK in particular is going to enter a more and more austere environment, don't you think regulation should be looked at again?
Well, it's not quite true to say that the United States has got anything, because in North America, US and Canada, there are 63 different regulatory jurisdictions. Now, in the UK and indeed the whole of Europe, we've got 1 jurisdiction. And what we do is we regulate the process, the lending process, not the product.
There's no cap in terms of regulation?
No, because there's no requirement to be a cap, because we have to be totally transparent with our charges and consumers can make the choice of what they do. When we were in the boom times, people were borrowing large sums of money from banks over long periods of time. They really don't want to do that anymore. They want small sums to tide them over a particular issue. And if you made those totally unavailable, which is what I understand the Australian proposals will do, then you're not helping anybody. You're actually making things a lot worse for people.
That's indeed what Cash Converters Peter Cummins says. He says it will ruin the business, and he says, luckily, Cash Converters is big enough to go elsewhere. And he was hinting heavily to me the other day that he would go to the UK. Would you welcome a bigger Cash Converters in the UK?
If there's a market for it, that would be his business decision. But where I agree with Peter Cummins entirely is not particularly that it'll damage the business, but it will damage the consumer. Because if what you need is a few $100s for a few weeks, and you can only get more than $2,000 over a longer period, you're not getting what you need. You're not getting what you want. You're getting something completely different.
John Lamidey, thank you very much for joining us.
Thank you. Nice to meet you.